building of buckets in financial modeling is a critical skill for any financial modeler. For accounting students, this is just replicating in Excel the concept of T accounts. The whole point of a bucket is, so in this example we're doing debtors, to have an opening balance, so you'll see we're starting with nothing, to then have rows that fill the bucket. So anything that will add to debtors, so we've got sales here. We've then got a row of what takes away from debtors. So in this case it's repayments, and we've set it up to repay 1 month later. And then we've got a closing balance. In terms of calculations, all this does is add the ones up above. And then most importantly, the opening balance of the next period should equal the closing balance of the prior period. One of the benefits of a bucket is the ability to make changes to it if certain new circumstances come about. So for example here we've got the situation, we can obviously change our sales, but what happens if someone tells us, oops, we forgot, what about the bad debts? So to make this work, it's very simple. We could insert a new row. We're going to call it bad debts, and we're just going to set it up that 10% of sales will go bad. Because that's an input, I'm going to make it a color. So what we're saying here is that we are going to lose out minus whatever we sell times that cell there. This is not an input, it's a calculation, so we're going to do that. I can copy it and paste it, so that's done. But now you should quickly be able to spot, if you use a bucket, where things don't make sense. So as you can see here, the closing balance is going negative. This is a useful check, so we now know something's wrong. And if you investigate, you'll discover that we're selling 155, we've got bad debts of 16, and yet in the next month, we're collecting 155 based on this calculation. So it seems like the problem is that we haven't taken away the 16 here. So what we're going to do is we're going to build another formula. So this is an offset function which you'll learn later. What we're going to do is just replicate it and change that to F8. Copy and paste that across. And now you'll see this payment is the sum of those two. It goes all the way across, and quite importantly, the closing balance now makes a lot more sense. If for whatever reason, let's say repayments change to only 2 months later, notice that automatically the bucket updates itself, closing balance works itself out, and we get these calculations, and we've got a more realistic view of what the debtors will look like. Another benefit of buckets, especially when you're doing them in conjunction with financial models, is that typically they contain all the information you need relating to the financial statements. So here when we're doing our debtors calc, you'll notice we've got a closing balance, so that's a debtors balance which will sit in the balance sheet. We've got sales and bad debts, those two items will go to the income statement, and we have the repayments which will go to the cash flow. So this one simple bucket can feed our 3 financial statements and make sure that they always stay in sync.